$110 million. I mean, just think about that number for a second. That is the exact amount Banzai International agreed to drop to acquire a company called Hyros. It was supposed to be this absolutely monumental deal, a real game changer for both of them. But, well, things didn't go as planned. The deal spectacularly fell apart, it sparked a wildly complex financial crisis, and it threw Banzai into a literal fight for corporate survival. Let's get into it.
Welcome to The Explainer, everyone. I am so incredibly pumped to guide you through this today. We're doing a really deep dive into Banzai's web of debt. We're talking SEC 10K filings, a massive breach of contract lawsuit, the whole shebang. We're going to untangle exactly how a company tries to survive when a massive deal just vanishes and all the bills suddenly come due. I absolutely love unpacking corporate survival stories like this. So let's make some sense of all this dense financial maneuvering going on behind the scenes. So here's our roadmap for today. We're going to kick things off with the failed SPAC catalyst, untangle that web of debt, look at some really strict covenants and defaults, break down debt equitization, and finally, check out the incredibly tight repayment timeline.
All right, kicking off with Section 1, the failed SPAC catalyst, or basically Banzai's sudden need for capital.
You see, to really grasp the debt situation, we have to look at what triggered it. Back in March 2023, Banzai hires Markham as their auditor to review the financials. Fast forward to July 2nd, and Hyros is providing responses to open audit items. Seems normal, right? But then, out of nowhere, Markham resigns. This just threw a massive wrench in the gears. By July 31st, Banzai terminates the merger agreement entirely. There's actually a breach of contract lawsuit happening over this right now. But the main takeaway? This collapsed timeline completely stripped Banzai of a massive, desperately needed capital injection.
And what's super fascinating here is the specific language at the center of that lawsuit. Look at this phrasing from the engagement letter. The engagement ends on the earlier of termination, quote, including without limitation our resignation or the delivery of the report. That's pretty unambiguous, right? It basically meant that the second the auditor resigned, boom, the engagement was over, limiting their liability for any losses that followed. It is wild to see how strict contract phrasing can just completely unravel a $300 million back deal, leaving Banzai scrambling for a lifeline to stay afloat.
Which brings us right to Section 2, the web of debt. Let's actually look at the specific financial instruments Banzai relied on to survive.
Now, before we meet the actual lenders, we really need to clear up some corporate jargon. You're going to hear me say the phrase convertible promissory note a lot today. Simply put, this is a type of short-term corporate debt. Think of it like a corporate IOU. But here's the kicker. The lender has the option to convert that debt into equity, meaning actual real shares of company stock, instead of forcing the company to pay them back in hard cash. As you'll see, that flexibility becomes absolutely crucial to Banzai's whole survival strategy.
Okay, let's dive into this. These are the major plates Banzai is currently spinning, pulled straight from their SEC filing. First up, Yorkville. They have multiple notes totaling millions, with terms allowing conversion to Class A stock, plus an early redemption premium. Then we've got GEM, holding a $1 million note where the conversion price is tied to the previous day's trading volume-weighted average price, or VWAP for short. And then, well, then there's the heavy hitter, CPBF Lending. Banzai owes them a balance of nearly $4.9 million on convertible notes, carrying a staggering 15.5% interest rate. Ouch. All right, moving on to Section 3, covenants and defaults. Because, as you can probably guess, this kind of short-term, high-interest debt comes with some incredibly strict strings attached.
Think of these as tripwires. Banzai's debt agreements define an event of default super broadly. We aren't just talking about failing to pay cash. If they miss an SEC filing deadline, default. If they default on a totally unrelated debt, default. If they can't deliver stock shares to a lender on time, or even if their stock just gets suspended from trading, literally any of these can trigger a default across the whole board. The pressure on them to maintain absolute perfect compliance is just immense.
And if Banzai trips even one of those wires, a vicious domino effect starts. Step 1, the default officially occurs. Step 2, lenders immediately exercise their rights, demanding instant cash repayment, often slapping on a massive penalty premium. Step 3, if the cash simply isn't there, the debt is forced to convert to stock on terrible terms for the company, which heavily dilutes the existing shareholders, which ultimately leads us to Step 4. The sheer financial weight forces the company to severely cut back or completely shut down operations. They are walking a literal razor's edge here.
So how in the world do they survive? That brings us to Section 4, Debt Equitization Explained, which serves as Banzai's ultimate escape hatch.
Now, I want you to imagine this scenario.
How does a company pay off almost $5.5 million in outstanding, high-interest debt when their cash reserves are basically running on fumes and they just lost out on a massive SPAC acquisition? Any guesses? The answer is exactly 302,794. Between August and September 2024, Banzai executed a major debt reorganization strategy. They issued exactly that many shares of Class A common stock directly to their creditors to cancel out that massive chunk of debt. So this is what we call debt equitization. Banzai is quite literally using their own company's stock as a currency to satisfy these lenders. The SEC filing is super explicit about this. They use this strategy with creditors like Yorkville, GEM, and Verisa Partners. For instance, Banzai issued over 450,000 shares to Yorkville throughout 2024 just to satisfy those promissory notes so they wouldn't have a balance by year-end. They did the same thing with GEM and Verisa. When you don't have the cash, your equity basically becomes your only lifeline.
But the big question is, will it be enough? Let's move to our final section, the repayment timeline, and take a look at the ticking clock they're up against.
The maturity profile in their 10K paints a picture of absolute nail-biting urgency. Look at this. Nearly $10.8 million in principal and accrued interest is due in less than 1 year. And the amount due in 1 to 3 years? Zero. Yeah, you heard that right. Almost the entirety of Banzai's massive debt load isn't safely spread out over the next decade. It is due right now, as in within the next 12 months. Let's look at exactly who is knocking on the door, expecting a piece of that $10.8 million. You've got CPBF leading the pack, owed almost $5 million on those 15.5% convertible notes. Then you have Agile Capital owed $1.8 million. Various private placement notes at $1.88 million, Yorkville with $1.2 million, plus 1,800 Diagonal and Boot Capital. It's a lot, right? This perfectly visualizes the intense, immediate financial pressure Banzai's executives are dealing with every single day. Because remember, every single entity on this list has the power to trigger those default dominoes we talked about earlier.
Which leaves us with this final, really provocative question. We've seen how Banzai lost their SPAC funding. We've seen how they racked up millions in incredibly strict, short-term convertible debt, and how they're aggressively using debt equitization to pay off lenders like Yorkville and GEM with stock instead of cash. But with the clock ticking on over $10 million due in less than a year, will their equity escape hatch actually be enough to keep these plates spinning, or is the dilution eventually going to catch up with them? It is a fascinating masterclass in high-stakes corporate finance, and for sure, it's a story we're going to be watching very closely. Thank you so much for joining me for this explainer, and keep learning.